Well, hello everyone. Welcome to Trading Price Patterns. I have a jam-packed class for you today. I've got 3 announcements that we're going to start off with. We have 2 trades that we placed in the companion class to this called Trading a Smaller Account that have hit targets. We're going to review those. We have 5 trades that require a little bit of trade management, a little bit of loving. And then we have 3 brand new trades, example trades that we would like to place. So, and all of that in a 4 to 5 minutes. So we're going to be clipping along. I want to thank all of you who are here and already bringing this class to life by being so participatory in the chat. Hello to Josh, who I got to meet live and in person at an event in Anaheim. So hello to Josh and APA and Marcus, and do not copy, like some of your handles are great. And Jackson and Lee and Trader and Frank and Scott and Life in the Fast Lane and Sia and Sharon and the rest of the gang. We also have the privilege of having Mr. Kevin Horner with us here in the chat. He's a friend and a fellow coach. And so if you've got questions, please don't hesitate to ask. I invite you, if you aren't already doing so, to follow us in the land of X. My handle, Barb Armstrong CS, Kevin's Kevin Horner CS. We're posting content there on a daily basis that we think you'll find helpful and informative. And, you know, it's another way for us to communicate with you outside of the webcast a platform like this. So just before we get into the thick of things today, know that options carry a high level of risk and aren't suitable for all investors. Know that while we focus on technical analysis, because this is called Trading Price Patterns, so that makes sense. Know that other approaches, including fundamental analysis, being aware of earnings season, what's going on globally within the world and within our own country, tariffs have been a big topic of conversation and their impacts on the market this year as well. So we want to have a well-rounded approach to making our investment decisions. We use the Paper Money software application on the Thinkorswim desktop platform, and it is a brilliant place to learn and hone your trading strategies. One of the differences, however, is that short options will never be assigned early in Paper Money, and that can happen in a live account, and we'll talk about that as we're doing our trade management today. Okay, so like I said, I've got 3 announcements. We're going to do a quick market overview. We're going to intersperse our trade management with the placing of new example trades. So we've got a lot to cover. So the first thing is, if you have never been to an in-person event, this one is now closed. The New York Market Drive that is coming up this Saturday at the New York Marriott Marquis. Now, if you live within striking distance of New York and you want to join us, we can register you on site, but it's always best to register ahead of time. If you don't make it to that event, there is an event coming up the middle of July in Santa Clara. We don't even have that on this slide anymore because it is beyond maxed out. That 2-day event in Santa Clara, and then we'll be back in New York in August. Kevin Horner will be at the New York event in August. I will be at the event this weekend along with Ben Watson. Ben will be at all of them. And then Ben and Kevin will be in Chicago. That leads me to announcement number 2, and that is that I will be teaching this class next Wednesday, and that will be the last time I will be teaching this class until at least the middle of August. I'm due back around the 18th of August. I'm calling it the Barb 2.0 project. I'm having a knee replacement surgery, and so I'll be off for 6 weeks. And so this class has been taught as a companion class with the Trading a Smaller Account class on Mondays and Fridays. Connie Hill is going to be teaching that class starting this Friday until at least August 18th. So Connie will be taking over Trading a Smaller Account. And Kevin Horner will be stepping into the driver's seat, and he will be covering this class. So this class for the next month and a half will no longer kind of be treated as a companion class to the Trading a Smaller Account. So if you're wondering where I've gone, it's to a land of, sexiness with ice and walkers and a lot of physical therapy. And hopefully by the time I come back, I'll have ditched the walker and the crutch and all the things. And I may not be running marathons. But I did cross the finish line for the New York City Marathon the last time I was there. I didn't run 26.2 miles, but I did cross the finish line. Anyway, so that's, announcement that's 2 and 3. Okay. So, but I will be here next Wednesday. Okay. So just so you guys are apprised of what's going on. Okay. Let's go out and have a quick look at the markets. So the S&P 500, we had a great fall. We've had a great comeback. And it's not at all-time highs, but if you had a good arm, you could hit it from there. The NASDAQ, however, actually did hit a new all-time high today. So way to go. NASDAQ, typical overachiever, right? And it's now up, 4.8% year to date, which, a lot of us are pretty excited to see. And the S&P 500 up a more modest 3%, but it's still in the green for the year. Okay. Okay. So that's that. Now, how about the Dow? Because it was kind of like, trailing along and it, like the others, set up this inverted head and shoulders pattern, and it crossed yesterday and still seems above. Now, these support and resistance lines, they're not a specific line in the sand. They're more of a range. And so, we're seeing it, head to the upside, but this is made up of 30 stocks and they're based on the price of the stock. And, so this one's had a little tougher time digging its way out of the hole after UNH took such a great fall and has really not been back on the comeback train yet. Yeah, so, Sia is saying it seems to be hitting resistance, and some might say it's hitting resistance. It's flirting. I'd say it's flirting. Some might say it's breaking out. It depends on where you draw your line. So jury is still out. It's hanging out at that resistance level. And will that resistance become a new support? Well, stay tuned. Okay, and then let's look at our volatility index. And geez, like this is down at the low end of where we've seen it since what? Really at the low end for this year. It's at the low end of the range. We haven't seen it this low since, the beginning of February. So sitting at 17.3, interesting given all the things that are going on in the world, but there seems to be a lot of confidence in the market. Okay, as spot on as it sometimes could have been. And trade management is really critical. And given that we have one more session together next week before I'm gone, Connie will be managing this particular account while I'm away. But when we I want to look at this short put. So when we sell a put, we're agreeing to buy the stock. And we did this on Chipotle at 52. It's now at 54.7. 2 days to expiration, it's worth a nickel. And if we come and we look at the chart, you might say, oh, there's no chance. Never say never, my friends. But, here's where our short strike is. And there's an expression that Ben Watson uses if you've ever gone to one of his 2-day events, getting started with a technical analysis and getting started with options. It's like spend the nickel to avoid the pickle. And so we are going to spend the nickel to close this out and take any potential risk off the table. And for some reason, there wasn't an exit on this. So maybe I had put it in as a day order. So we're going to see if we can get out of that for a nickel. We've got 95% of our max gain. So we're going to say, yeah, we're happy. Sorry, 96.5. So we're cool with that. So we're going to close that one out. So that's CMG, trade number 1. Okay, let's look now. And these other two are kind of clipping along. And, we have a lot to cover today, but you could come and look at Affirm and at SMCI. We put those trades on there and they're just kind of clipping along. Actually, Affirm, we may have bought that one a little earlier. SMCI, up nicely today. Some of these we have more than one trade on, and we were going to compare and contrast them. So we may come back and look at these again next week, because SMCI, we sold a put. We also did a buy right covered call, and that one's working nicely too, that you saw on the chart. But CELH, we don't have a stop on. And I had some kind of system issues one day. So this might have been one that we just couldn't get the stop in, and I was going to do it later. But this is one of those things with trade management. You want to look and just see if you've got, make sure you have exits on your position. So we bought the stock way back here. So we've done a lot of wash, rinse, repeat on this, where we've sold a covered call and then bought it back for less and sold another one and bought it back. And, and so we sold another one here and we don't have an exit. And so if you're looking at, well, where might one put an exit? So you could say, well, if I look at this recent low here at 42.24 and I went 3% below that, that would have a stop around 40.97. And so that's where we're going to put our stop. Because, we're up $743.50 on this example combination of trades, plus all the other covered calls we've sold on this, on a $26,000 account. Like, that is a grand slam, my friends, at the bottom of the ninth. But this is an unrealized gain. So what the market giveth, the market can taketh away. So we're looking at, if we put in a stop at 40.97, there's no guarantee we're going to get out at exactly that price, but we're looking to try and protect some of that gain. So we're going to highlight this entire trade and say we want to create a closing order to exit the entire position. And that means we're buying back the call that we sold and selling the stock if and only if Celsius goes at or below 40.97. Confirm and send. And we're putting that in our buy right covered call group. So now when we come in here and we look at our buy right covered calls, we see these little chiclets beside all of them, right? And if we don't see a little chiclet, it means we don't have an exit in place. Now, Goldman Sachs, that was the third one I wanted to look at. And why do I want to look at that? Like, we're only up $205, but we're up 4.6% on the 7 shares that we bought when? We come to view trades. We bought that like the 18th of June. That was last Wednesday. Like, that's a pretty nice return in a week. But again, unrealized gain. So, so we put a target here. And you may say, like, that seems to be in the middle of nowhere. Why did we do that? Well, we looked at this. I think this was like based on a Fibonacci target. And so if we want to say, like, hey, if this continues to go up, we're great. But our stop is at 591.30. It's down here. And so we might say, well, hey, I know we just put this on a few days ago, but this is uptrending. If we were to use this 30-day moving average as a support level, and you say, okay, it's currently at 616.86, that 30-day moving average, we'd want to adjust our stop to 598.35. And so we're moving the stop up by about $7. And so we want to give it enough room, that if it sets up a bull flag and pulls back for a few days, we don't get stopped out. But, we want to, kind of manage the damage. So we're going to edit this, and this is just a drawing line on the chart, but we're going to move it up to 598.35, and then we'll look at this again next week. And if it's continued to go up, we may just move the stop up, or we may say, if we get a hammer, or a hanging man pattern or something like that, we may just say, hey, that's a nice profit and we're okay with taking it. Because here's a potential level of resistance right here, this former high. So it may kind of spend a few days there or may get hung up there. And would we be surprised to see that? We would not. Now, to actually change our stop, we're going to come to Goldman Sachs and we're going to take this 591.30 and we're going to cancel and replace that, and we're going to make it 598.35. And this is just, it's kind of like good trading hygiene, if you will. It's just, being disciplined. Even if you're saying like, hey, this is on a tear, it's not going to come back there. Well, it could. We've seen crazier things happen. So we want to be prepared. Now, someone in the chat said, well, what about Boeing? Well, those were trades 4 and 5, were both Boeing. So Boeing's, there's a play called The Play That Goes Wrong, actually. And it's kind of a slapsticky, but if it's done well, it's pretty funny. This is not so funny. This is trades gone wrong. So we had a long call vertical that I think was at 210 and 215. So, which means we wanted it to get to 115 and stay above. And we put that trade on this day. So, this had been like uptrending since the beginning of April, like April 7th, when the market hit its bottom and started to turn around and everything started going up. And, we had this Harami pattern here. And so the entry was legit. And in fact, it did go up the next day, but it is not doing well since. And this short put vertical expires this Friday. And at 205 and 200, it is through both strikes. And especially as you approach expiration, then the risk of assignment can become higher. So we've looked at, taking the money and protecting some of our positions. This is a trade gone wrong, and it's just time to fess up and say it's not getting any better. Now, we haven't ignored this, but, we had this big hammer pattern here. And then it looked like it was moving to the upside. And then I was visiting my daughter and grandson in Bend, so I was ignoring the markets. And then it looked like it was moving up again on Monday. And so we said, we'll leave it till Wednesday. Well, yeah, it's not looking so hot. So time is up. Okay. So we are going to come here to Boeing on our short put vertical. And this kind of blows my mind. Like, I would think it's 2 days to expirations. It's through both strikes. We've got to have hit our max loss, but we haven't. It's at 385. We could still lose another $115. So we are going to close this out. We were hoping to buy it back for probably 26 cents. We were hoping to buy it back for 25 cents. We're going to have to buy it back for 380. And yeah, does that kind of bite? It does. But you know what? Not all trades are profitable. And I think I gave you a quote from the CEO of an investment firm, and he said, the key to successful trading, one of them is admitting quickly when you're wrong. And on this one, maybe we could have admitted it a little faster. But better late than never. Okay, so we're going to get out of that one. Now, we were going to compare and contrast, and we could still do that, but we also did a long call vertical on Boeing. Here's our call vertical. And we were hoping, the hope is a four-letter word in the land of trading, but the expectation was to buy it back when it hit $4. Yeah, we're going to buy it back at 28 cents because now, like, it's way low. And even though we have until July 3rd, time is working against us on this one. So better 28. And some might say, hey, I position size so that I can afford, to take this hit. But, if you're saying it's not looking strong, time is working against me, I'm just going to exit this position, take my $28 and live to trade another day. Okay. And I'll make sure that those get filled. So that's our 2 trades on Boeing. The trade's gone wrong. So let's look at a couple of new trades. And let's start with something yummy. Company called Yum. I'm just looking quickly at questions. Yeah, so NVIDIA is an interesting one because I think it was NVIDIA I was looking at. So somebody said NVIDIA seems to be leading the way. So NVIDIA is up almost 4% today. We did a short put vertical on NVIDIA and we put that trade on here when it was kind of going sideways, and that's worked out pretty well. Now there's no sign that it's finished going up yet. But like if tomorrow, we're at 71% of our max gain, and our goal is to get out, when we're up 80. But that and Goldman Sachs. Now, here's another one. Goldman Sachs is up 75%. Our goal is to get out at 80, and now it looks like it's pulling back. Might be pulling back a little. So do we take the money on that? We only put this trade on the 18th of June. We put this trade on last week, and we were willing to be in this until July 11th, and we're within a stone's throw of our max gain. So I like to kind of run a semi-democratic class. So let's do a little poll. So on Goldman Sachs, do we want to cue Steve Miller and take the money at 75% of max gain, or do we want to wait for that extra little bit? So, and we'll go ahead and place a new trade and then we can come back to that. But this is where our strikes are. Okay. So let's come and look at Yum. So with Yum, this is a stock that's been on the struggle bus. Like, and many stocks in the market came, April 7th, they started uptrending. Yum started rolling down the hill. But today we have this diagonal resistance breakout. And I think this is one that I posted on a chart on X. So they upgraded this to overweight. They've lowered the price target to 162, but it's currently trading at 146. And then when we look at June 10th, Redburn Atlantic upgraded it to a buy with a price target of 177. Goldman Sachs upgraded it and has a target of 167. That's all of these are above this recent high. And so what could you do as a trader? Well, you could buy the stock. And if you were doing this as an income generating thing, you could put in a target up here around 161, kind of a longer swing trade. With our smaller account, we have a lot of this money currently invested. Could we do a long call vertical? Well, let's come and look at the options. So only monthly options, but it's trading at 146. We've got hundreds of contracts in open interest. Could we do the 145 and the 150? Could we even do the 140, 145? We're through both strikes. And would there be enough room, to get a little bit of profit there? 375. So it would just have to stay above 145. So 375, we want a 25% return times 1.25. That's 470. That's pretty close to max gain. So how about instead we do the 145, oops, sorry. 145, 150. Now we're at 250 times 1.25. A 312. And we started kind of being a little more conservative with our targets on these. So we're saying, hey, when this gets to 312, we'd like to buy it back. Now this looks like it moves in 5-cent increments. So I'm going to make that 315. And we're going to leave that at day. I don't know why this is. Okay, let me just do this again. Would appear I'm on the struggle bus with my. Okay, let's delete the first one. Well, why did it delete both of them? Okay. I only want one of these. Well, actually, we can do two because, because we're risking 235. We can risk up to 400. So we're going to make this 315. Well, 235 now times 1.25, 295. So maybe my struggle paid off, and we're going to make this. This is weird. So for some reason, it's not letting me come in and make this good till canceled. So we're just going to put this trade in, and then we can go in and adjust that exit. So we're going to do a long call vertical. Okay. So we're into that trade. Now, when we come to the monitor tab, we can see that we bought these two at 220. And we have this exit, but the exit expires today. So we're going to come in, cancel and replace, and just change it to good till canceled. And put that in our long call vertical bucket. And sometimes it's not that you had a system hiccup. Sometimes maybe you just forgot. Yeah, sometimes you just forgot. Okay, so that's Yum. Let's have a look at Google. So with Google, here we have something, that's again been kind of counterculture or counter the trend of the general market in that, it hit this high here in February. Actually, it hit a market low like everything else did. So I take that back, market April 7th. And then it has been kind of climbing its way back up the hill, not as a dramatic a rebound as the NASDAQ or the S&P, but it's kind of been going sideways. And on Monday, it seemed to find this similar bottom to, this range it's been at before and is bouncing. Now we do have earnings coming up July 22nd. So that's after the monthlies close. So yes, I know we did 2 long call verticals on Yum. That was deliberate. Okay. But here, we could do a long call vertical maybe at 165 and 170. Well, now it's at 170, but let's see if that's possible on Google. Oh, this is with a 250 wide spread, and that's at $1.68. What if we did 167.50? We've got tons of volume on this. So that's at 145. It's already through both strikes. So it's kind of a more conservative way to consider trading this. So at 145 times 1.25, that's 181. So let's look at the chart. Say, okay, if it just stays above here, we'd have our 25%. You might say, like, why are you being such a wuss? Why aren't you going for something higher? Well, you know what? If we can make 25% in sometimes a few days, now we could lose 25%, but like, that doesn't sound like a wussy move to me. That sounds kind of interesting. So if I look at that and say, well, if I did 3 of those, how much am I risking? 435. Is that under 500? It is. So we could do that. And then we're going to put in our target. Oh, sorry. Create opposite order. Single order becomes first trigger sequence. Right click. Now create opposite order. 148 times 1.25, $1.85. So when that gets to $1.85, we're going to take our 25% and call it good. And again, I'm getting this weird thing happening here. So I'll go in and adjust that afterwards. And we're going to put that in our long call vertical bucket. Now, how long might this take? Well, who knows? It didn't take long to fill. So again, I'm going to come to Google, and these are in alphabetical order here. I've just structured them that way. This is a day order. We want it to be good till canceled. So I'm going to come in and correct that. So this kind of leads me over to 2 trades that we put on Monday in trading a smaller account. And one was, okay, let me go to my other sheet, Cisco. And if you didn't see that class, you may want to check it out. So on Monday, we said, hey, I spy with my little eye a cup and handle pattern. Do you guys all see that? You know, oops. Here we go. Here's our kind of cup and handle, our cup and our handle. And, you know, a technician might measure from here to here. And if you wanted to buy the stock, you could buy the stock and put a target, you know, from what? This went from 52 to 66. So you might say, I'm going to put a target $14 higher. So I'm going to put a target around 80. But we just said, hey, how about we do this long call vertical with a 25% return than we want out? Well, we got out of that this morning. So you could have been out walking your dog and exited that trade. And so if we want to look at that, come to account statement, and we're just going to type in Cisco. We can see we placed this trade on Monday and we got out Tuesday at $1.96. And, you know, our target was to get out at $1.95. And we did 3 contracts. Okay. So we did 3 contracts. So just to walk you through the math, if you are new and you've not done these before, let me shake my little Etch-a-Sketch here. So we got in for 152, out for 196. So what did we make? We made $44 per contract, or 44 cents per share times 300 shares, because we did 3 contracts. And so that was $132. So a base hit. You know, but we say, hey, we rang the cash register, we're happy campers, okay? And if you want to look at your return on risk, how much could we have lost? Well, we could have lost that whole $1.52 a contract, or $150 per contract. We ended up making 44 cents off that 152. And so our return on risk, it turned out to be 29%. You know, we were going for, 40, we were going for 25%, but sometimes, like when the market's moving around a lot, you know, our fill and our target aren't totally perfectly aligned. But, 29%, we'll take it. Now, the other one that we put on Monday was Dash. So I've never actually used DoorDash, but it had been kind of going sideways. And then on Monday, it started to break out. And so we said, okay, we're going to do this long call vertical at 225 and 227.50. And if it just stays above, and that one we got out of this morning. So the other one we hit yesterday. So it's just like base hits, my friends, like little win. And sometimes it's a little loss. Like we just had 2 losses on Boeing. So, we don't win all the time. But, if we can do these little wins and stack them, and so what did we make on this? Well, 35 cents a share or $35 a contract times we did 5 contracts. Because what were we risking? $1.30, 130 per contract. We really should have only done 4. So that must have been a slip of the calculation there. But we made on that one $175. And I'm not taking transaction fees into account here in this example trade. But, that was another base hit. So we'll take it. And then what was our return on risk on that one? It was 35, that's what we made, divided by 130 or $1.30 per contract, which is what we were risking. That came out to 27%. And how long were we in these trades? One we were in for 1 day, this one we were in for 2. And so sometimes when we're more conservative, and then you're going, well, if I'd stayed in longer, I could have made more. If you stayed in longer, perhaps. But if we stayed in longer, we also could have ended up losing. And this is what used to happen to me on long call verticals all the time. Because I'd buy a long call vertical, and if I could make 100%, gosh darn it, I didn't want to do any of this wimpy, 25% return stuff. I wanted that 100% by GAR. And you know how often I got it? Almost never. And so that's when we went with this 50% target. And then with all that tariff shenanigans earlier this year and so much whiplash and uncertainty, we said, you know what? Maybe we'll go to 25. And that's been, kind of working out a bit of all right, except when it doesn't, and things don't always work out. Okay, so believe it or not, we have reviewed 2 trades that we got in on Monday and that we're now out of. We have reviewed an additional 5 trades that we've done some trade management on. 2 were losers, and 1 we exited the position. 2, I think we adjusted stops. Oh, and then Goldman Sachs. The vote was overwhelmingly to take the money and run. So this will be our 6th one, our short put vertical. We said we wanted out at 28 cents. We've been in it for a week and we're within a nickel of our target. So we're going to take that. So we're going to come up to our Goldman Sachs trade, say we're going to cancel and replace. It's like, you want 33 cents? You know what? I'll give you 34. I'm feeling a little generous. So that's our short put vertical. So, and somebody said, so a short put vertical, it could expire worthless. But there was a guy, if you've ever gone to a live event, his name is Ray Kimbrell, and I'm not telling, tales out of school. He has told this from the main stage. And when I was a client, I heard him tell this, and you would think I learned the lesson. I had to learn my own lesson, but I got burnt once and learned really quickly. It was on an index that settled the next morning, and it expired worthless, and then the market dropped dramatically. It was on the SPX overnight, and I went from max gain to max loss by the time it closed out. But Ray Kimbrell tells this story of, he had a trade, it was worth a nickel. He had 3 opportunities where he could have closed that out for a nickel. And it's like, he didn't want to pay the nickel. And he ended up, it cost him $3,500. He ended up with a loss. So don't, sometimes we can learn lessons from other people. We don't have to pay the tuition, which in Ray's case was a $3,500 tuition. Mine might have even been more, but it was at least that amount. Yeah. So anyway, speaking of short put verticals, shall we go look at a short put vertical opportunity? Because we just closed one out, we could do an example. Okay, so we've got 5 minutes left. We'll squeeze in one last trade. Yes, and Bob is saying, and he makes a good point, I kind of like short put verticals, but the risk to reward ratio isn't as sexy, or as potentially lucrative as it is with, say, a long vertical. And that is true. But when we look at this here and we say, okay, could we, this has had quite a run, which started on, the 4th of April. And it's come up and created this big dramatic kind of flag pattern, and, kind of a flag blowing in a stiff wind. It's been kind of going sideways the last couple of weeks. But could we sell the 120? And if we kind of look back further, I probably drew that line for a reason. So we had this big double bottom pattern, and then it broke above, and it's been hanging out above that. So could we come and maybe sell a short put vertical at 120 and 115? Let's see what the strikes available are. So if we came out to July, we've got 450 contracts, a relatively tight bid-ask spread. Now you can go to the trade management mini sessions for example trading plans on the Trader Talks platform, where we want it to trade more than 1 million shares a day and, have 20 times the number of contracts and a tight bid-ask spread and all of that. So if we get $1.35 for this, and, we're risking 365, our rule of thumb is if we're in this for 23 days, we want at least a 23% return on our risk. And we're getting close to 37 potentially. So we're just going to say, okay, that looks pretty good. Now, how many contracts are we going to do? We're only going to do one because we are risking $365. So this is never going to be a grand slam. It only has the potential to be a base hit. Because the most we can make is, what we got paid to get into the trade. Well, maybe make it 27. And again, I'm getting this weird thing going on. So we're going to put this in, and then I'll go in and adjust our expiration date. So guys, our 45 minutes, it has come, and it's rapidly coming to a close. We've done a lot today. So we closed our 2 trades that didn't go well on Boeing, the short call vertical and the long put vertical, but we managed to avoid taking max loss on either one. We opened a new trade. We bought 2 long call verticals on Yum. We did a long call vertical on Google, and then we did a short put vertical on Goldman Sachs. We also did trade management on Chipotle, where we took our 97% return on our short put. We added a stop on Celsius Holdings, CELH, the buy right covered call, or the covered call that we have on that. We exited a position on Goldman Sachs because we had, within a nickel of our target on Goldman Sachs. And, I taught swing trading yesterday, and we put a trade on Lyft. And so it's pulling back a little bit today, but if you want to catch that class, it's in the archives. You're welcome to go back and have a look at that. So my ask as we wrap things up today is, one, if you haven't hit the like button, hit like. It helps move it up in the algorithm so more people can, find this content. 2, if you haven't subscribed to the channel, you'll want to hit that subscribe button so that you can, access this content quickly and easily. If you've never been to a live event, you'll want to check that out. And then there's a survey link that Kevin just reposted. And if you hit that survey link, 2 questions. 1, I hated it. 10, I loved it, and everything in between. And then I promise if you add a comment, not only will I read every comment, so will the management team. So, and I will pass those on to Kevin, who will be covering this class starting at the 10th of July or whatever it is. So I will be here for this class again next week before I go and do my Cripple Creek thing with my knee replacement. So guys, have a really awesome week. If I don't see you next week, have a fantastic summer. And if you're going to be in New York, I'll see you on Saturday. Take care, everyone. Thanks to Kevin and to the guys behind the scenes for all their help. Bye for now.